Ever think about like the whole journey of crypto? Bitcoin especially. It started with this huge promise, right? Financial freedom, doing things differently, almost like a rebellion against the system. But now, especially with the crazy markets lately and some of these big collapses, you kind of have to wonder, did those dreams, maybe turn into a bit of a financial nightmare for some people?
That's a really interesting way to put it. And it kind of gets right to the heart of what we'll be looking at today, that whole evolution. From those early idealistic promises to some, well, maybe some harsher realities we've seen in the crypto world. And of course, we're going to be using those awesome discussions you shared with us to kind of guide us through it all.
Yeah, your sources are great. They're transcripts from some super in-depth YouTube conversations. And they really get into it, no easy answer. So we're going to trace it all the way back, the very beginning of Bitcoin, then unpack all this stuff about decentralized finance, DeFi, and take a hard look at some of those market crashes, the ones that definitely felt like nightmares for some people. Oh, and we can't forget the whole debate about central control versus decentralization. Still going strong.
So our goal, as always, is to help you make sense of it all, cut through the noise. There's so much information out there. We want to pull out the key insights from these discussions, explain the tricky parts in a way that everyone can understand, and basically help you see the big picture. Where do Bitcoin and all of crypto stand today? And what does it all mean for you? That's what we're going to try to figure out.
Okay, so let's go way back to 2008. Might seem like ancient history in the crypto world, right? But our sources really point out that Bitcoin was born in the middle of that whole global financial crisis. It's like the seeds are planted right there. That's when Satoshi Nakamoto, the mysterious creator, unveiled Bitcoin. And a huge part of it was this deep distrust in the traditional banking system after all the craziness that went down back then.
It's amazing to think back to what actually happened in 2008. Our sources get into the details. Huge institutions, tons of leverage. They were borrowing like crazy compared to how much they actually had. Talk about an unstable system, right? And on top of that, this lack of transparency. No one really knew what was going on with some of those financial instruments. It was a recipe for disaster, and that's exactly what happened. Contagion, they call it. One thing goes wrong, and it triggers this massive chain reaction. Asset prices tank, margin calls go out, banks start collapsing or barely hanging on. And in the end, governments had to step in. Huge bailouts, taxpayer money. It was a mess.
Bailout city. And one of our sources points out that Satoshi saw all of this and was like, nope, not doing that again. Bitcoin was built as the antidote to the system. Decentralized payments, can't reverse the transactions, and no need for those middlemen, the banks that mess things up so badly. Plus, it's all out in the open on the blockchain. You can see the transactions, no hidden debt, no sneaky leverage within Bitcoin itself. Everything's transparent.
And that's super important. Traditional banking. Debt is at the core of it. Every deposit you make is basically a liability for the bank. Leverage is baked right in. Even the dollars we use are kind of like debt issued by the central banks. Bitcoin, totally different. It's not anyone's liability. It exists on its own, independent on the blockchain. Not backed by debt, doesn't represent debt. And in Bitcoin, there's no safety net, no central authority to print more money and bail anyone out. It's all on you. You make the decisions, you're responsible for what happens.
So in early 2009, when that first Bitcoin block got mined, it resonated with a lot of people, right? This whole new financial world, transparent, nobody could censor you, no governments or big institutions calling the shots. Especially appealing for those who felt burned by the old system.
Totally. At first, it was all about the ideology. But then Bitcoin's price started going up and up and up. And that opened up a whole new level of appeal. The chance to get rich. If you were smart enough or lucky enough to buy Bitcoin when it was worth just a few cents or dollars, well, the gains have been unbelievable. It's like winning the lottery. And that naturally changed things for a lot of people getting into crypto.
You got it. Suddenly, it wasn't all about philosophy and changing the world. It was about making a ton of money and fast.
And that brought in a whole new wave of people, including folks from the traditional finance world, drawn to the innovation, the potential for huge returns, and this whole new asset class. But here's the thing, and our sources really point this out. Not everyone from the old system bought into Satoshi's vision. They weren't necessarily distrustful of traditional finance. Some of them were just looking for an edge, a new market to play in, using the same old strategies. Leverage, maximizing gains, and, that kind of thinking can bring back some of the same problems that caused trouble in the first place.
Yeah, some people just saw a chance to make a quick buck using the same old playbook, and this is where it gets really interesting. The sources you shared really zoom in on the Terra Luna collapse in 2022. It's like a perfect example of how those old vulnerabilities can creep back into this supposedly revolutionary crypto system. Deja vu all over again.
What's fascinating is how quickly those lessons from traditional finance had to be, I guess, relearned in the crypto world. The Terra Luna crash, May 2022, that was a brutal wake-up call. It showed those financial risks playing out all over again. Terra USD, that was an algorithmic stablecoin, right? Pegged to the US dollar, supposedly, using this complicated mechanism with its sister token Luna. And it just blew up. Lots of people got caught up in it, retail investors especially drawn in by the promise of stability and those crazy 20% yields, and boom, their investments disappeared overnight. Talk about a financial nightmare.
Brutal is right, and it didn't stop there. Your sources bring up Three Arrows Capital, or 3AC, this big hedge fund with roots in traditional finance. They got hit hard by the Terra crash, and it really showed how interconnected everything is in crypto, and how much leverage can magnify the damage.
Exactly. 3AC was playing with a lot of borrowed money, huge leverage, amplifying their bets, essentially. When Luna crashed, it triggered this massive credit crunch across the whole crypto industry. Suddenly, all those less liquid assets were under pressure. And then you had things happening outside of crypto, like the Fed raising interest rates. That hurt a lot of speculative assets, including crypto. Bitcoin went from its all-time high, over $67,000 in late 2021, all the way down to under $20,000 by June 2022. Ethereum too, massive crash. The whole crypto market lost 2/3 of its value in a really short time, just wiped out.
2/3, that's insane. And it's like, as your sources point out, the pattern was so similar to 2008. Hedge funds using borrowed money for big bets, piling into assets that looked safe at the time, then margin calls and forced selling. It's almost like financial history was repeating itself.
The parallels are definitely there. The Terra collapse, it triggered margin calls for everyone using leverage, including 3AC. They couldn't come up with the collateral, so they had to sell other assets, even the ones that were doing okay, which just made the whole market go down even more. Contagion effect, just like in 2008. And 3AC ended up defaulting on their loans, going bankrupt. Their bankruptcy filings are super interesting. They show how entangled the crypto lending system had become. 3AC borrowed from DeFi platforms, those are the decentralized ones, but also from major centralized crypto lenders and exchanges. CeFi, they call it, centralized finance.
So both types of platforms got hit. But did DeFi handle it better than the centralized lenders?
Here's the interesting part, and your sources really get into this. A lot of those core DeFi protocols actually held up pretty well. They operate on this over-collateralization principle. You have to put up more collateral than you borrow. And they've got these automatic liquidation mechanisms built into their smart contracts. So when the value of collateral drops too low, the smart contract automatically sells it off to cover the loan. It limits the losses for lenders. But the centralized lenders, some of them weren't so strict with collateral requirements, and they lent a lot of money to companies like 3AC. Voyager Digital and Celsius Network were two big ones that got into trouble. They had crazy leverage ratios. Celsius was at 19.1, Voyager around 23.1. Super risky, especially when you remember that even lower leverage ratios were a huge concern for traditional banks back in 2008. These crypto lenders were playing with fire, basically, investing in super volatile assets with very little capital to back it up. And both Voyager and Celsius went bankrupt in the end.
Those leverage numbers are wild compared to traditional finance. But here's the big question. The crypto market lost $2 trillion. That's a crazy amount of money. So why didn't it cause more damage outside of crypto? You know, like the ripple effects we saw in 2008.
Good question. The discussions you shared offer a few explanations. One idea is that a lot of people in crypto saw their investments as super risky, like gambling. So when things went south, it hurt them personally, but it didn't cause widespread panic or a credit crunch. It was contained.
Kind of makes sense. If people think of it as high risk, high reward, those losses might be bad for individuals, but not for the whole system.
Right. And then there's this ironic twist. In 2022, everyone in crypto was focused on creating these so-called safe assets. Algorithmic stablecoins like Terra USD, platforms like Celsius and Voyager promising those high, stable yields. Sounds familiar. It's like what happened with those AAA-rated mortgage-backed securities in 2008. Supposedly safe, but we all know how that turned out. In both cases, people were putting their money, sometimes money they couldn't afford to lose, into things that seemed safe but weren't, often with borrowed money too.
So the search for safety, or the illusion of safety, played a role in both of these crashes.
It seems like a recurring theme in finance. But the biggest reason why the crypto crash didn't spill over into the traditional financial system is that they're still pretty separate. Most big banks and traditional financial institutions didn't have a lot of Bitcoin or other crypto on their balance sheets. They were cautious, worried about volatility. So when crypto prices crashed, it didn't really threaten those big players. They were still able to lend money for mortgages, businesses, all the important stuff. Crypto was doing its own thing, groundbreaking, but not yet deeply woven into the real economy.
Okay, so we've seen how that early vision of a decentralized financial system, free from the problems of the old world, ran into some roadblocks. It even repeated some of the same mistakes. Which brings us to DeFi, decentralized finance. For those listening, this is all about building financial services directly on blockchain technology, cutting out the middleman. So what's the big idea here? What's the potential?
DeFi wants to create a financial system that's more transparent, easier to access, and more trustless. It uses blockchain technology and smart contracts to do that. The idea is to automate stuff like lending, borrowing, trading, all through code. No more centralized intermediaries that you have to trust. That should lead to better efficiency, lower fees, and more people around the world getting access to financial services.
Trustless, in theory, maybe. But our sources point out that it's not that simple in practice, especially with these centralized crypto exchanges, the CEXs, like Binance, Coinbase, those big ones.
Right. Even though DeFi is all about decentralization, most people still use those centralized platforms to buy and sell crypto. And using a CEX means you have to trust them. You're trusting that they'll handle your money responsibly, keep it safe, and follow the rules. But we've seen what can happen when that trust gets broken, like with FTX. People lost a lot of money.
So if the goal is to avoid centralized entities, what are the real decentralized options in crypto?
Decentralized exchanges, or DADX, are where it's at. It's very different from centralized exchanges. On a CEX, the company holds your funds, and they have this order book to match buyers and sellers. DXs, on the other hand, are basically collections of smart contracts that live on the blockchain. These smart contracts handle the trading directly between users' wallets. Peer-to-peer, no middleman holding your assets.
And a big innovation that's made DEXs possible is automated market makers, or AMMs, like Uniswap and SushiSwap. How do AMMs work compared to those traditional order books on centralized exchanges?
So centralized exchanges use a central limit order book. Buyers and sellers put in specific orders at certain prices, and the exchange matches them up. AMMs are totally different. They use liquidity pools, basically pools of 2 or more tokens that users have deposited. Instead of an order book, they have a mathematical formula that determines the exchange rate between the tokens. One very common formula is the constant product formula. X times Y equals K. X is the amount of one token in the pool, Y is the amount of the other token, and K is a constant. It never changes.
So how does that formula actually work when you're trading on a DEX? How does it figure out the price?
Say you want to trade some USDC for ETH on an AMM. You put your USDC into the liquidity pool and get ETH back. This changes the ratio of USDC to ETH in the pool. But the AMM has to maintain that constant product, that K value. So the price of ETH in terms of USDC automatically adjusts based on the new supply and demand. If someone buys a lot of ETH, the amount of ETH goes down, the amount of USDC goes up, and the formula makes the price of the remaining ETH go up. The bigger the trade, the bigger the price impact.
And who puts those tokens into the liquidity pools in the first place? What do they get out of it?
They're called liquidity providers. They deposit equal values of 2 different tokens into the pool. Like if ETH is trading at $2,000 and you want to provide liquidity to an ETH-USDC pool, you put in 1 ETH and $2,000 worth of USDC. For providing that liquidity, they usually get a share of the fees every time someone trades using that pool. But there's a risk, too, called impermanent loss.
Impermanent loss. Sounds kind of scary. What is that exactly?
It happens when the prices of the tokens in the pool change a lot compared to when the liquidity provider put them in. Because the AMM is constantly rebalancing to maintain that constant product, you might end up with a different ratio of tokens when you withdraw your funds. And the total value of those tokens might be less than if you had just held onto them in your wallet. It's called impermanent because you could get that value back if the prices go back to where they were.
So it's a trade-off. You can earn fees, but you also risk losing some value if the market moves against you. Now, DeFi isn't just about trading. Lending and borrowing are a big part of it, too. How does that work in a decentralized way?
DeFi lending protocols like Compound and Aave mostly use over-collateralization, kind of like margin lending in traditional finance. You put up crypto as collateral to borrow other crypto. But because crypto prices are so volatile, they usually make you deposit more than you borrow. The key difference with DeFi lending is that it's all automated through smart contracts. The contract sets the interest rates, the collateral ratios, and it automatically liquidates your collateral if it drops too low. that protects the lenders.
Got it. Like a high-tech pawn shop where the smart contract is the impartial middleman. What about regular loans, the kind where you don't need collateral? Is DeFi doing anything with those?
Uncollateralized lending is way harder in DeFi. It's because crypto addresses are pseudonymous. You don't really know who's behind them. Traditional loans depend on trust, knowing who you're lending to, their credit history. That's hard to do in crypto. But there are some new ideas out there. DAOs, decentralized autonomous organizations, could be a way to do uncollateralized lending. A DAO is basically a community with shared resources and rules that are governed by code. So the idea is that a DAO could pool its money and then decide as a group whether to lend to someone based on their on-chain activity, their reputation in the community, maybe even some off-chain checks. It's bringing in social trust and human judgment into the mix.
So even in DeFi, where everything seems to be about code, trust is still important. It's just trust in a different form, more community-based. And that tension between freedom and security, it really comes up when you look at what happens in the real world. Your sources mentioned the story about a crypto investor who lost $24 million in a phishing attack back in 2023, a DeFi platform. What happened there? What's the lesson?
That was a tough one, and it shows the risks, even for experienced crypto people, especially in DeFi where things are always changing and getting more complex. This investor got tricked into using a fake website. It looked exactly like a real DeFi protocol they use, and through that fake website, they were tricked into approving a malicious smart contract. It was disguised as a normal increase allowance button, which is common in DeFi.
Yeah.
You need that to let smart contracts use your tokens. But in this case, clicking that button gave the attacker full control over the investor's funds. Gone. Over 10,000 ETH, plus a bunch of DAI stablecoin. Just like that. It reinforces